All right, this is a test recording because I'm trying to see if my mic actually sucks or this is something going on. So here we just have something that's just showing us the interest rates, right? Well, not interest rates. We're talking about interest rates and how the expenses, what it costs to borrow money, and how that impacts different asset classes. So here we have the asset classes and what I believe to be least risky to the most risky. And when it becomes harder to borrow money, pretty much people take their money away from the risky assets. Not saying this exactly happens, but it's just better to put your money in places that are safer when it's going to be you're expecting it to be harder to borrow money in the future. So if it's harder to borrow money in the future, right? I want to prepare for the future now by putting my money in safer investments. If it's going to be easier to borrow money in the future, I can take a risk now because I know that I can still recoup or add to the positions or to the investments that I plan on doing. So that's just kind of like the duality because ideally in the financial market you want to think ahead. Ideally you want to be making decisions for the future, not now. It's better to be predictive, right, than it is to wait and be reactive because by the time you're reactive, it's already too late. If you already started pulling your assets after the market went down 50% in crypto, you're already too late. You're stuck. You're stuck holding and you could have diamond hands, but now you also will have an empty pockets. I do personally believe in crypto. I believe that there's a lot of companies that are coming into space. A lot of things in technology that are being built that could help overall, but I also understand that how investment works, especially at an institutional level, because we're now seeing institutions join in crypto. Like they're in the party now. It's not just retail investors, right? This is people who have tons and tons of capital and that are attracting other people who want their capital to grow. So when that happens, right, now crypto, right, in some cases it becomes less volatile. That's why I believe we're not seeing the highs that we expected from 2020 into 2022 where we're going up to 5k. Instead we just been stuck underneath it. It's like we had a nice bit of like growth, right? We had a nice bit of like push, but now we're seeing like from the previous highs we're seeing like a 50% drop. And I feel like that's largely due to just the Feds taking a hawkish stance, meaning that we're not going to get as many rate cuts as we're expecting this year. And because of that, investors and people are preparing by just moving their money to things that are less risky. And that's what I believe is happening. Do I think crypto is done? No. I do think we could, just looking at this from a technical perspective, just seeing all the wicks, this is a strong level of support that we're seeing around this $2,000 level. And I mean, shoot, what it already rebounded like 32%, like from its most recent low, just due to increase in volatility, the sell off on the assets. But really, what's happening too with the alts is that Bitcoin dominance is just going up. Bitcoin is a much even though Bitcoin is still risky, it's considered the digital gold. So gold is like a safe haven in some aspects, at least globally. So when we look at less risky to risky, right? Even though crypto is still on the riskier side, it's starting to because so many world governments and people are are investing into it, it's starting to become like an exotic. And even though I didn't put like oils and gold and all that, that's what I'm saying when I say exotics. So it's getting closer to that side where it's just like there's not a lot of volatility, not necessarily not a lot of volatility, but there's not as much risk mentally associated with Bitcoin now, especially as we're starting to get more like Bitcoin, pro Bitcoin government policies, I guess, or people that are involved in Bitcoin and cryptocurrencies. So we're starting to see that shift because even with like Ethereum, like they lost a whole bunch, but Bitcoin is still like floating at 100K right now, at least at the time of the recording of this video. I think something to pay attention to or research if you are a trader is to look into the bond yield curve because the bond yield curve kind of lets people know what environment we are in from a market perspective. and knowing what type of market we're in, from monetary policy, or at least like the flow of money, will help you understand or predict what will happen in the future. So this is my quick video just talking about what's going on with the crypto market, and explaining what's happening. The TLDR is that it is going to be harder to borrow money. It's expected to be harder to borrow money in the future because of the Fed's hawkish standpoints. So people or investors are preparing for this by removing their money from their risky assets and preparing them to either have the money sit on the shelf or invest it into things that are safer and more less likely to lose their money. Again, at the institutional level or the larger level, yes, it's about growing money, but it's more about protecting the capital than it is about getting a 50 or 60% gain, right? That's amazing if you have like $2 billion and you get 60% off it. That's insane, right? But if you have $2 billion and you get 2% off of it, that's pretty good. Like, you gotta think about, if you were in that situation, you had $100 million to your name, right? You have a lot of money. Would you what would you prefer? Where would you prefer to put your money at? Somebody that 1 year they're gonna go 100%, the next year they're gonna go negative 40. Then they're gonna have 1 year where they go 20%. Then they're gonna have another year where they go 60%, negative 60. That's too many ups and downs. Or would you rather have the person that's gonna give you 2 to 4% consistently every single year? Some people might take the 50% guy, or the 100% 1 year guy. But just think about it, if that was actually your money. If one day you woke up, or you have $100 million, it goes up to $200 million, right? But then the following year it's back down to like 150. You're gonna be like, oh, that's not that bad. Then it goes to 180. You're like, oh, that's not that bad. Then it goes down to 90. Whoa, hold on. Then it goes down to 50. Whoa. Versus the guy where it's like, oh, I had 100 million. It's at 102. It's at 106. It's at 110. Right? There's just less volatility. There's less up and down in it. And the more money you have, of course, the bigger that percentage becomes. But you much at a higher level, it's all about protect. It's more about protecting capital. You want to protect capital and grow capital. You don't want to risk it and lose it all, because it's not it's not easy making a lot of money. But that's it. I went a little bit over. Hope this video helps you guys. I'm trying to give you guys free game and just give back to the community so that you guys can learn about macroeconomics and use that shit to help you trade.